Welcome to the Stock Market Palantir. Today we are going to talk about OLPX. OLPX Holdings, a stock that I think really embodies the term battleground. This company has had a brutal public journey. And here we are in late 2025, and it finds itself just compressed. It's in this perilously tight range between about $1 and $1.30. And that $1 line, it's not just psychological, it's a huge regulatory trigger that defines all of the immediate risk here.
Exactly, and you can see that pressure clear as day in the recent price action. We got that brief, sort of hopeful spike, what was it, a 5 to 7% rally right after the Q3 2025 earnings? They marginally beat expectations, reported 2 cents EPS on 114.6 million in sales. But that relief just vanished. It was immediately erased, pushing the stock right back down toward that 115 mark. And I don't think this was just year-end tax loss harvesting. This reflects a really overwhelming, persistent institutional skepticism that just will not lift.
That skepticism, if you look at it through the lens of market microstructure, it is stunning. We're seeing off-exchange short volume ratios that are frequently blowing past 40%, sometimes spiking over 60%. And the time it takes for shorts to cover is still sitting around 9 days. Now look, that is not the trading profile of a healthy stock. But the real issue, the core question, is whether the market is just fundamentally wrong about this company's survival.
And that gets us right to the heart of the conflict. Is all this extraordinary short pressure a sign that the market has, completely mispriced a fundamentally strong asset? Or is the market just being rational about what looks like structural decay?
Well, my position is pretty clear. I think OLPX is a compelling deep value play. The market is pricing the stock for eventual failure, which is frankly illogical given the company's proven ability to generate massive profits and cash flow. These headwinds they're facing, they're temporary, and the valuation gap between the market price and the underlying quality is immense.
And I see why you think that, focusing on those historical metrics. But I come at it from a completely different angle. For me, OLPX is a classic value trap. The structural erosion of their revenue, especially in their key growth channels, coupled with this relentless, overwhelming institutional bearishness, which is actively controlling the price movement. It just means the high probability of a reverse stock split is looming large. That $1 regulatory line, it's a cliff, not a floor.
Okay, but let's ground this in financial reality for a second. The claim that the company is failing is just inconsistent with its balance sheet. OLPX is highly profitable. They still boast exceptional adjusted gross margins. In Q3, it was 71.5%. They delivered positive adjusted EBITDA of $30.8 million. This is a business that's generating substantial cash, not one that's teetering on the edge of insolvency. And crucially, their turnaround strategy, that bonds and beyond pivot, is actually showing results where it matters most. The professional channel, the foundation of their brand authority, it stabilized and grew by 5.3% year-over-year in Q3. That suggests the core relationship with stylists is, fundamentally intact. And look, let's not overlook the August 2025 settlement of that Lillian Securities class action for $47.5 million. That removed a massive, unquantifiable legal overhang, making valuation and risk assessment much, much clearer now.
That's a powerful defense, I'll grant you, based on margin quality and, cleaning up the balance sheet. However, while they are profitable, that profitability is masking some pretty significant structural weakness. Let's look beyond the margins for a second. Net sales still declined 3.8% year-over-year. The core problem here is market share loss, primarily in the segment that was supposed to drive all their future growth. Yeah, the critical specialty retail channel, that's where brand reputation is made or broken with younger consumers. It declined sharply, 13.5%. This is where the competition from dupe products, particularly from giants like L'Oreal, is hitting the hardest. Add to that the lasting brand damage from their previous legal troubles, and you have a permanently fractured growth engine. That 5.3% growth in the pro channel, while positive, it's simply too small to offset the bleeding in retail. And this is where the market structure really comes into play. That extreme and persistent institutional short pressure, which we see through the high off-exchange volume, it shows you that the so-called smart money is actively positioning against this brand. They are absorbing any buying demand, pinning the price, and making that regulatory deficiency process a near certainty if these dynamics continue.
I acknowledge the weakness in specialty retail, I do. But that doesn't just negate the fundamental strength that's providing a floor for this stock. We're talking about $286.4 million in cash on the balance sheet. They're aggressively deleveraging. They've cut long-term debt from over $640 million down to $352 million. A 26.9% adjusted EBITDA margin means they are swimming in cash flow. At its current price, the stock is trading barely above cash per share, and that reflects pure sentiment, not the financial reality of the asset.
Okay, but I'll push back on that. I grant you the cash position provides a stability cushion. But if the company is so undervalued and if management genuinely believes the stock is being priced for failure, why aren't we seeing aggressive buybacks? Why aren't they using some of that $286 million cash pile to defend the price and counter this short pressure? The lack of a forceful defense suggests to me that management either views that cash as necessary operating capital or they just believe the short pressure is too overwhelming to fight directly.
Well, that could be a tactical decision. Maybe they're waiting for maximum impact, or maybe they're preparing for a strategic event. Because that resilience, $30 million in EBITDA in a challenged quarter, combined with this depressed valuation, it leads me to the biggest catalyst outside of an organic turnaround: acquisition speculation. With a portfolio of 170 patents and a market cap near all-time lows, OLPX represents a deeply valuable, fundamentally sound target. A major player like a Unilever or an Estee Lauder could buy instant market authority and IP on the cheap, especially now that the biggest legal hurdle is cleared.
Acquisition speculation is always the last refuge of the bull when the operations falter. But let's shift back to what is actually controlling the near-term fate of the stock. Market microstructure. The threat of the NASDAQ listing rule 5450 is not some abstract idea. It's a tangible threat to the company's capital structure. Why did that Q3 rally fail to hold? It's the stuck nature of the price, and it's driven by high dark pool volume. You have to think of it like an iceberg. Most of the selling supply is hidden off exchange. When institutional sellers execute hedges or shorts in these dark pools, it just absorbs any retail or short covering demand without ever showing visible sell orders on the lit exchange where we all trade. This constant, invisible shadow supply creates an effective price pin, and it systematically grinds the stock closer and closer to that $1 deficiency trigger.
I'm just not convinced by the absolute inevitability of that downward spiral. You're viewing that $1 threshold purely as a market weapon rather than what it could be, an asymmetric point of opportunity. While yes, the company is perilously close to triggering that 30-day requirement, sophisticated investors and the company itself have a powerful incentive to defend that level. Avoiding the reputational and structural disaster of a reverse split creates a very strong speculative hard floor. The downside is regulatorily defined, while the upside, based on those exceptional margins, is potentially massive.
That defense is purely psychological, though, and I would caution against relying on it. Even if OLPX manages to defend a dollar now, if that price is ultimately breached and a reverse split, say a 1 for 10, is forced, history shows that that action is viewed by the market as absolute kryptonite. It's a sign of managerial desperation, and worse, it makes the newly higher price equity available to major short-only funds that previously couldn't touch a sub-$5 stock because of their mandate restrictions. It just invites fresh, aggressive, bearish pressure on that inflated price, and it often causes the stock to fall right back down to a new floor.
We've talked a lot about institutional control, but let's consider retail sentiment for a moment, which I believe signals a critical turning point. If you look at the major retail investment forums, the narrative has shifted. It's moved away from just sharing losses, the loss porn phase, to a consensus around the binary bet thesis. Either the turnaround succeeds or they get bought out. This suggests to me that widespread capitulation has already occurred. The masses of bag holders waiting to sell at break-even are largely gone, and that means that massive overhead supply is reduced, leaving only conviction buyers who are betting on a systemic change.
That's an interesting anecdotal observation, I'll give you that. But the quantitative data suggests that retail activity is generally reactive, not predictive for OLPX. Spikes in retail interest usually follow a price drop or a legal filing, They don't precede sustained rallies. The intense correlation between the institutional dark pool activity and the stock price action confirms that retail is currently a follower, not a driver. The truth is, that fractured retail community is holding dead money until a major institutional catalyst like a massive buyback program or an M&A offer forces a change in this established microstructure.
But waiting for the perfect institutional catalyst means you miss the entry point when the fundamental picture is already so compelling. The removal of the key legal uncertainties, combined with the incredibly high margins in the stabilizing professional channel, provides a tangible floor. This isn't just a speculative gamble. It's a strong entry point based on a clear valuation mismatch.
I'm sorry, but I just don't buy that the operational turnaround is strong enough to counter these external headwinds. Yes, they are profitable, but the structural decline in specialty retail, the lasting damage to brand trust among younger demographics, and the overwhelming active institutional shorting in the dark pools are simply too heavy to ignore. Until we see decisive, consistent revenue growth that can offset this operational deleveraging, OLPX remains firmly classified as a value trap.
So at the end of the day, the future of OLPX Holdings really hinges entirely on which force prevails. The company's internal resilience and turnaround efforts, particularly their ability to stabilize and reclaim market authority through that professional channel, or the external market structure pressures focused so relentlessly on that $1 regulatory barrier.
It is a profound conflict. We're debating a stock that holds exceptional gross margins, over 70%. Yet it faces this intense institutional short pressure that's executed primarily off exchange. Everything, absolutely everything, revolves around the gravity and the market consequence of breaching that $1 floor.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.